Before you do anything with your silver position today, you need to hear this. I know what it feels like to watch a metal that touched $96.40 just 4 days ago now print a morning fix of $83.48. I know the voice in your head asking whether you missed the top, whether this is the beginning of something worse. They want that voice to grow louder. They want you second-guessing every ounce. They want you to believe that 83.48 is a sign the structure has cracked. It has not cracked. It is a decision point. It is Thursday, March 5, 2026. Silver's official morning fix settled at $83.48. The session range today runs from $81.74 to $86.98. And in the next 48 hours, non-farm payrolls will either confirm the floor or stress test it. Ladies and gentlemen, analyst here. This is the most important price action moment since the January all-time high. Let us dissect it precisely. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow John A.G. World for the latest analysis. Let us build the full technical map of what silver is doing right now, because every single level matters today. First, the morning fix itself. Market data trackers confirm silver futures sit near $83.20 Thursday, with the previous close at $83.47. The session range today has printed between $81.74 on the downside and $86.98 on the upside. That $81.74 print is critical. Reports confirm silver fell back toward $83 in Thursday trading after briefly surging toward $86 earlier in the session, a nearly $3 intraday swing in under 8 hours. This is not calm consolidation. This is compression volatility. And compression volatility on the right side of a major pattern is the most dangerous setup for anyone positioned on the wrong side. Now the moving average sandwich. Technical analysis trackers confirm silver's 50-day simple moving average stands near $82.70. A second technical framework places the 50-day SMA at $85.35 with the 200-day EMA at $85.82. These datasets from different analytical approaches both point to the same conclusion. Silver at 83.48 is trapped inside a convergence zone, where multiple moving averages are clustering simultaneously. This clustering only resolves one way, with a breakout. Up through 85.82 to confirm recovery, or down through 81.74 to test the deeper support at $80.87. The Fibonacci architecture. Analysts note the nearest bullish Fibonacci targets from the current zone are $80.87 at the 0.236 retracement level, $91.98 at the 0.382 level, and $100.01 at the 0.500 level. Support below sits at $72.92 and $65.19. The entire zone between 81 and 85 is the 0.236 Fibonacci band, the first meaningful retracement support after the full cycle move. Markets that are structurally bullish do not spend long below this level. They absorb it, build from it, and push toward the next band. The RSI reading per technical trackers, silver's 14-day RSI sits at 53.9 neutral territory. Not oversold, not overbought. Precisely the zone where markets absorb their most recent move before the next directional decision. RSI of 53.9 carries a specific message. Tuesday's crash selling has been processed, but new buying conviction has not yet committed. Both sides are watching the same levels. The MACD reading is negative 1.32, a mild sell signal in isolation. But when MACD is mildly negative and RSI is neutral near 54, the combination does not confirm downtrend. It confirms indecision. Indecision at a critical support zone resolved by a single macro catalyst is the most actionable technical setup in the metals market right now. Community trackers confirm a symmetrical triangle forming on the 2-hour time frame, compressing between descending resistance from Monday's 86 surge and rising support from the Tuesday 81 low. These two lines are converging. Per technical pattern rules, symmetrical triangles resolve with a breakout equal in magnitude to the triangle's height. From 82 to 86 is $4. Measured move in either direction. Upside target approximately 88 to 90. Downside risk approximately 78 to 80. The 52-week context confirms the structural story. Sources indicate the 52-week range for silver futures spans from $29 at the low to $121.78. Silver at 83 sits more than 151% above its 12-month floor. The metal is not collapsing. It is consolidating after one of the most powerful commodity moves in modern market history. Now the fundamental forces generating this precise technical setup, because the price action does not exist in isolation. First mechanism. The dollar's violent round trip. Currency trackers confirm the dollar index rose to 98.91 on Thursday, reclaiming ground after Wednesday's sharp retreat. The Wednesday decline was the dollar's most significant single-day drop in 3 weeks. It happened when reports emerged of Iranian operatives exploring terms for ending the war, briefly driving oil lower, stocks higher, and silver toward $86 in Wednesday trading. Then Thursday, Iranian state authorities denied the outreach. The dollar climbed back. Silver retreated toward 83.48. The macro data that supported Thursday's dollar recovery. According to reports, Wednesday's ADP employment report showed 63,000 private sector jobs added in February, stronger than the 50,000 expected, and well above January's weak 22,000. Simultaneously, the ISM Services Index for February surged to 56.1, the strongest services expansion pace in 3.5 years. The services prices paid sub-index simultaneously fell to 63, an 11-month low. The combination hiring above forecast plus services expansion at multi-year high kept Fed rate cut probability contained. When rate cut probability stays contained, the dollar holds strength and silver faces a ceiling near 85 to 86. Thursday's catalyst distinction. Analysts note March 5th delivers U.S. initial weekly jobless claims, the first of 2 labor market readings this week, before Friday's payrolls. The strategic significance is precise. ADP showed 63,000 jobs added. If Thursday's jobless claims print comes in elevated, it contradicts ADP's positive signal and creates labor market ambiguity. Labor market ambiguity equals Fed path uncertainty equals dollar softening equals silver window. The prior week's claims figure was 206,000. A meaningful print above 225,000 would constitute the first genuine softening signal of this labor cycle. Second mechanism. Iran outreach reversal. Currency trackers note Thursday saw the dollar reclaim above 99, after Iranian authorities denied the peace talk outreach that the New York Times had reported Wednesday. Tehran's denial removed the de-escalation signal that had briefly weakened the dollar. The market is being whipsawed by geopolitical information quality. Each confirmed escalation drives dollar safe haven demand, which paradoxically suppresses silver's paper price. Each de-escalation hint weakens the dollar and unlocks silver's structural spring. For silver to break above 88 and attack the neckline, the dollar needs to soften sustainably, not for a single session on an unverified report. Third mechanism. Gold's recovery providing context. Market analysis trackers confirm gold may recover after recent decline with key resistance at $5,320.89 and critical support near $5,000 flat. Sources confirm when gold and silver recover simultaneously from institutional support zones, it signals structural accumulation rather than speculative bouncing. When both metals rebuild together from recognized price floors, the bid is structural. The supply deficit architecture, 67 million ounces for 2026, has not moved. India's 3,500 tons annual silver demand is undiminished. Solar and EV industrial absorption contracts remain active. A dollar moving 0.15% on Thursday morning does not alter physical demand already priced into global procurement cycles months in advance. The emotional sequence of this week's silver price action deserves its own anatomy breakdown, because every phase carries a distinct signal. Act 1. The euphoria ceiling. Monday silver reached $96.40, its highest print since the January 29 all-time high of $121.67. Market trackers confirm retail sentiment at that moment was at peak optimism. Community forums were calling $100 imminent. The narrative, war has arrived, silver is a safe haven, the breakout is confirmed. Act 2, the panic flush. Tuesday brought the 19% single-session crash. According to reports, the crash was driven by the dollar's strongest single session in months combined with oil surging above $84 Brent and the ISM prices paid reading destroying Fed cut expectations simultaneously. Sources confirm retail positions built above $90 saw 80 to 90% loss of confidence levels by Tuesday close. Act 3, Thursday's morning fix at 83.48 is where the emotional dust settles. Not capitulation, not euphoria. The flat zone of institutional patience. The pattern flushed to 81.23 on Tuesday futures, rebound to 84.96 on Wednesday per live price trackers, settle near 83.48 fix Thursday. Not collapse, not explosion, compression. Now the institutional sentiment signal. Technical analysis trackers confirm silver's overall signal is strong buy across multiple moving average timeframes simultaneously. The 50-day SMA generates a buy signal. The 100-day SMA generates a buy signal. The 200-day SMA generates a buy signal. 3 separate moving average timeframes all generating buy signals, while RSI sits neutral at 53.9. That combination translates precisely. The longer the time horizon, the more clearly bullish the signal. Short-term noise neutral. Medium-term structure bullish. Long-term foundation strongly bullish. the tourist transfer. The momentum chasers who entered above $90 chasing the war surge are now gone. They entered on FOMO, exited on fear, and transferred their silver positions to institutional buyers at 81 to 83. That transfer is the most important event of this week. Not the crash itself, the ownership change. Reports confirm Thursday's volatile intraday action falling to 83 after briefly surging to 86 represents exactly this dynamic. Remaining leveraged paper sellers completing their exits while institutional reloading happens quietly beneath the surface. When exits are fully complete, what remains is the institutional floor. And institutional floors built on 67 million ounce annual deficits do not collapse on Thursday morning. Claims data, the ADX reading of 15 per technical sources confirms, no strong directional trend right now. 15 on the ADX means neither bulls nor bears have full control. Whoever gets the Friday NFP catalyst on their side wins the week's directional decision. The most dangerous argument circulating this week is not about silver. It is about the dollar's alleged structural strength. The dollar bull case runs. Iran conflict has entered its 7th day. Currency trackers confirm the dollar rose to 98.91 Thursday. The conflict's extension pushes oil higher. Higher oil pushes inflation expectations higher. Higher inflation expectations push the Fed toward holding rates longer. Longer rate holds mean a stronger dollar for longer. A stronger dollar for longer means silver's paper price faces persistent compression. For a 24-hour trader, this argument is not entirely wrong. Here is where it breaks down for anyone with a longer time horizon. Currency Tracker's own data shows the dollar was already being undermined by Iranian diplomatic outreach reports Wednesday. The market is beginning to price conflict duration uncertainty in both directions. Per currency tracking notes, Trump's administration said it would ensure and escort vessels transiting the Strait of Hormuz, a softening from pure escalation toward managed conflict language. Markets priced that softening Wednesday by sending the dollar down its most in 3 weeks. One credible headline. One single session. 3 weeks of dollar gains evaporated temporarily. The contrarian read, every dollar spike in this environment is a relief rally built on temporary data beats. The ADP beat of 63,000 is the best private hiring pace since July 2025 per official release notes, but 63,000 monthly private sector jobs is barely a third of the 200,000 pace economists associate with healthy growth. The ISM Services Index at 56.1 is a multi-year high, but the prices paid sub-index fell to 63, an 11-month low. Services expanding at decelerating price pressure is not a high inflation confirmation. It is an inflation plateau signal. A plateau in services inflation with a fragile labor market does not build the foundation for sustained dollar dominance. Compare silver's own position to its history. Sources confirm the 52-week change for silver futures is positive 151.55%. 1 year ago, silver traded near $29. Today it sits at 83. That is not a market in retreat. That is a market that absorbed a corrective flush and returned to prices considered impossible 12 months prior. The bear case needs silver to break and hold below 81.74, today's session low, then close below 78 on a daily basis to begin constructing a structural breakdown argument. The next Fibonacci support below the current zone sits at 72.92 per analyst notes. To reach 72.92 from 83.48 requires an additional 10.8% decline. In an environment featuring active war, 67 million ounce annual deficits, ADP hiring recovering, ISM services at multi-year expansion, and Indian demand holding 3,500 tons annually. What fundamental argument justifies 10 additional % downside from today's fix? Analysts suggest none exists on current data. The bear case is dollar strength dependent. The bull case is built on a structural foundation measuring in the hundreds of millions of ounces. Thursday's morning fix is not the start of the next crash. It is the eye of the storm between Tuesday's shakeout and Friday's catalyst. This is the battle plan. 5 precise levels. 2 scenarios. 1 decision framework focused entirely on the 48 hours in front of us. Level 1, the session floor, $81.74. Sources confirm today's session low printed $81.74. That is the battle line. That is the line in the sand. Any daily close below 81.74 shifts probability toward the next Fibonacci support at 72.92. But notice the metal touched that level today and bounced. It did not close there. Technical trackers confirm primary institutional defense at 83 flat and 81. The institutional wall answered Thursday's test. Until it fails on a daily close, 81.74 is the floor. Level 2, the fixed zone, $82.70 to $83.48. Technical analysis confirms silver's 50-day SMA sits near $82.70. The official Thursday morning fix settled at $83.48. This 78-cent band between the 50-day moving average and the fixed benchmark is the most contested zone in silver's current structure. Daily closes above 83.48 keep the recovery arc intact. Daily closes below 82.70 threaten the right shoulder's structural integrity. Level 3. The moving average ceiling, $85.35 to $85.82. Per technical data, the 50-day SMA sits at 85.35 and the 200-day EMA at 85.82. Silver tried and failed to sustain a move above this band Thursday, printing an intraday high of 86.98 before pulling back. The ceiling is known. The catalyst needed to break it is also known. Dollar softening on Friday, NFP weakness. A daily close above 85.82 confirms recovery arc with real velocity. Above that, the next target is the 0.382 Fibonacci retracement at 91.98. Level 4, the neckline gate, $91.98 to $92.85. Analysts note $91.98 is the 0.382 retracement level. $92.85 is the 50% Fibonacci retracement of the full cycle. These two levels cluster together as the neckline of the inverse head and shoulders pattern. A sustained close above 92.85 confirms the pattern. Measured move from confirmation 104 to 110 as the primary structural destination. Level 5, the psychological battlefield, $100. Sources confirm $100. COMEX corresponds to approximately 300,000 rupees per kilogram. MCX in India, the domestic threshold that triggers the media cycle. Retail demand acceleration and cultural milestone buying. $100 is not just a price, it is a catalyst for the next wave of demand from the world's largest silver consumer. Scenario 1. NFP softens Friday. Payrolls print below 150,000. Dollar retreats below 98. Silver breaks above 85.82 on Friday close. Neckline test at 92 begins within 5 trading sessions. Diamond hands who held through 81 are in profit and adding strength on the break. Scenario 2. NFP beats Friday. Payrolls print above 200,000. Dollar retests 99. Silver tests 81.74 again. Fibonacci structure holds. The reload window extends another week. Backup truck, not failure. Timing gift for anyone who did not yet act. What do you think Friday's NFP delivers? Does the labor market soften and unleash the spring? Or does it beat and force another week of building? Drop your call in the comments. This is Analyst Out. The fix is set. The floor is loaded. Stack accordingly. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is John AG World, bringing you clarity in every market move. See you in the next one.